Good day, everyone. I'm Michael Chang, Chief Investment Officer, Fixed Income at RHB Asset Management. First of all, thank you for listening again, and this is my fourth podcast. I'll start off by giving key updates globally, followed by Malaysia. Over the past months, central banks of the advanced economies continue to provide the monetary stimulus via quantitative easing, or better known as QE, to stimulate their respective economies hit hardest by the COVID-19 pandemic. The US Fed and the ECB continued to be the biggest QE proponent given the scale of their buying. We can see that unprecedented monetary and fiscal policy responses were undertaken by governments to address the economic recession brought about by the current pandemic. Interest rates were slashed to zero, in addition to massive QE being unveiled to date. Fiscal measures were either in billions or trillions at highest levels as a percentage of GDP in history. In US itself, QE4, which is still ongoing, has already reached US 2.92 trillion, and that number is expected to increase to US 8 trillion in 2021. The US unemployment rate soared to a high of 13% from its lowest level in recent years of 3.53% end December 2019, before the COVID-19 pandemic struck the US. Given these developments in terms of year-to-date return prevalent in the fixed income space, assessed by sector returns, US Treasuries continue to be the best performer, returning 8.7%, followed by the US corporate bond of 5%. That said, riskier credits have yet to recover pre-COVID-19 levels, and this is exhibited in the returns by emerging market debt US dollar, high yield US dollar, and emerging market local currency debt, where the returns were ranging between minus 2.8% to minus 6.9%. Therefore, there's still value in these three fixed income classes, subject to analyzing rigorously its credit risks and their ability to navigate successfully through this pandemic. For Malaysia, on 7 July, the overnight policy rate was further reduced by another 25 basis points to 1.75%, and this cut was in line with our forecast. Year to date, the OPR has been reduced by 125 basis points to address the COVID-19 pandemic and is at its lowest since introduced on 26 April 2004, which was 2.7% back then. We believe this cut is needed as economic data remains weak. Weak show in the recent data, for example, in Malaysia's May industrial production, where it fell 22.1% year-on-year versus estimates of 29%. Malaysia's manufacturing sales also fell by 19.8% year-on-year in May. With these readings, it is expected that the second quarter of 2020 will be severely impacted, and therefore resonated the need for an insurance policy rate cut. Providing this backdrop support would be the low headline inflation, where the CPI for Malaysia has been negative for 2 months consecutively, in April and in May of minus 2.9% year-on-year. BNM has also reiterated that it will continue to utilize its policy levers as appropriate to create enabling conditions for a sustainable economic recovery, suggests a dovish monetary policy going forward. With a relatively dovish message from Bank Negara, the Malaysian government securities yield curve is expected to flatten and will give bonds a further price boost in the medium term. In terms of valuation of MGS, the spread between 10-year MGS and US Treasury has tightened 15 basis points again from 214 basis points in my May podcast, and has now broke below a key level of 200 basis points at 199.5 basis points. It was 267 basis points during the mid-March sell-off. This reflected the increased demand by both onshore and offshore investors as they rallied on the rate cuts. Even at 199.5 basis points, the spread is still wider than its average of 124 basis points from 2007 to 2020. Thank you for listening to this podcast. We hope that this podcast has been useful to you and gain insights to the bond markets.